Welcome and thanks for joining us today for the Need to Know series, specifically on Tier 1 and Tier 2 public sector entities, focusing on our proposed new accounting requirements in the exposure drafts PBE IPSAS 47 revenue and PBE IPSAS 48 transfer expenses. I'm Michelle Lombard. I'm the Director of Accounting Standards. And today I'll be joined by Leona and Carly. Please note the External Reporting Board, or XRB, is an independent Crown entity responsible for developing and issuing standards in New Zealand. We look after accounting standards, assurance, audit and ethical standards, as well as climate-related disclosures. We exist to enable high-quality decision-making for resource allocations for the benefit of the whole of New Zealand. We ensure our standards are internationally aligned and locally relevant. I'll just start off with some housekeeping matters while everybody is dialing in and as people and participants are joining us. I'm going to ask you to just please drop all your questions that you might have into the Q&A boxes at the bottom. We'll try to get to them at the end. This webinar will be recorded, and the slides and the recording will be available on our website shortly after this presentation. Today, I'm joined by Leona and Carly, who are both Senior Project Managers at the External Reporting Board. They're very experienced and have spent well over a year drafting and refining these standards to make it's an international standard, but to make it locally relevant. So I am very pleased that they get to present on these exposure drafts today, and we welcome any and all feedback. In today's webinar, Carly will cover off the binding arrangement principle that's contained in both standards or in both proposed standards, and then we'll move on to the proposal in the revenue ED. Leona will take us through that, and then go back to Carly to take us through the proposed transfer expenses EDs. We will then end with any questions that you might have. Lastly, before I hand over, I just want to highlight that any views expressed during this webinar are our personal views and not necessarily those of the External Reporting Board as a whole. Without further ado, I might hand over to Leona at the moment.
Perfect. Thanks, Michelle. So, big question, what are these proposals about? The proposals aim to provide clearer guidance for revenue and transfer expense accounting and improve the consistency, comparability, and transparency of financial reporting for public benefit entities. The EDs were developed using the IPSAS B standards, IPSAS 47 revenue and IPSAS 48 transfer expenses as a starting point, and making adjustments to make it fit for purpose in the New Zealand environment. Both these EDs are centered around coherent key principles, such as the binding arrangement principle, which we'll explain further shortly. Please note the consultation period for these EDs closes on 1 December 2025. We've given a 6-month consultation period to allow for sufficient time to consider the proposals. Lastly, before we move on to the binding arrangement principle, I want to bring to your attention our educational materials and support, which will be highlighted in orange boxes throughout this presentation. We normally don't create educational material for EDs, but to make it easy on everyone to understand the proposals, as they are quite lengthy, we released some educational materials with the EDs, which are available on our website. So if you want further guidance on a topic, please look out for these orange boxes as we go along. I'll now hand over to Carly.
Thanks, Leona. So before getting to the proposals specific to revenue transactions and transfer expense transactions, we'll take a look at the binding arrangement principle, which is fundamental to the accounting for both types of transaction. As you'll see throughout this presentation, the existence or otherwise of a binding arrangement significantly affects how a revenue or transfer expense transaction is recognized, measured, presented, and disclosed in the financial statements. Therefore, understanding how to identify a binding arrangement is critical to applying the proposals in these EDs. So what exactly do we mean by a binding arrangement? So as defined in both EDs, a binding arrangement is an arrangement that confers both rights and obligations, enforceable through legal or equivalent means, on the parties to the arrangement. Such an arrangement doesn't need to be in writing, although this will often be the case. The definition recognizes that arrangements in the public sector can be binding, whether a formal contract exists or not. So for example, legislative or executive authority may create an enforceable arrangement similar to a contractual arrangement. So let's take a look at two key aspects of this definition. So firstly, the rights and obligations in the arrangement must be enforceable. In other words, an entity must have the ability to enforce the terms of the arrangement and hold the other party accountable due to consequences that will be faced in the event of non-compliance. The ability to enforce the terms of the arrangement due to enforcement mechanisms in the arrangement can be through legal means or through means that are outside the legal system but are similar to the force of law. The EDs refer to these as equivalent means. The EDs include examples of enforcement mechanisms through equivalent means, with further guidance on whether those mechanisms may result in a binding arrangement or not. Some examples include cabinet or ministerial directives. Furthermore, an entity's customary practices, the operating environment, and past experience with the other party are also relevant factors to consider in the assessment. In terms of consequences that drive enforceability, these must have the ability to hold the other party accountable to satisfy its obligations. Consequences can be either explicitly stated in the arrangement, but can also involve implicit consequences that arise from an entity's customary practices. The other key aspect of the definition is that there must be at least two parties to the arrangement that have their own enforceable rights and obligations under the arrangement. The rights and obligations of the two parties are interdependent and inseparable. Therefore, each party in the arrangement has both a right and an obligation. If one of the parties does not have a right or an obligation, then it is not a binding arrangement. In some arrangements, there may also be third-party beneficiaries that receive the promised goods or services in the arrangement. These entities or individuals do not have enforceable rights and obligations under the arrangement. And finally, there needs to be at least one compliance obligation. This concept is applicable to revenue accounting and will be addressed in this presentation shortly. Determining whether a binding arrangement exists should happen when the arrangement is entered into, but also when there are changes to the terms and conditions in the arrangement. This determination may, in some circumstances, involve significant judgment, and therefore the EDs contain guidance to assist with this. For a quick recap on the binding arrangement principle as you work through the proposals in these EDs, you can refer to this section of the presentation, or you can watch our webcast, which is available on our website through the link provided here. Now, before moving on to our next topic, I want to talk briefly about appropriations, which are described in both EDs as authorizations granted by a legislative body, in other words, an enabling authority, to incur expenses or capital expenditure for the purposes specified by the legislature or similar authority. This aligns with the Public Finance Act 1989. An appropriation may be one of the relevant factors to consider when assessing whether a binding arrangement exists and is enforceable. However, an appropriation does not on its own prove or disprove enforceability. A key question to ask yourself is whether or not the appropriation clause in the agreement or the arrangement has substance. For example, if enforceable rights or obligations exist before the appropriation process is completed, then the appropriation clause does not have substance. And conversely, if the arrangement is not enforceable until the appropriation process is completed, then the appropriation does have substance, and the arrangement will not be binding until this process is completed. In the New Zealand context, it may be rare for appropriations to have substance. Most arrangements are already in effect due to other enforcement mechanisms, such as enabling legislation. An appropriation merely serves as the authorization to incur expenses or capital expenditure. I just want to note that the illustrative examples in both EDs depict two scenarios, one where the appropriation has substance and another where it does not. But ultimately, when assessing whether a binding arrangement exists, you need to consider the arrangement in its full context, taking into account its unique terms and conditions, and assessing whether both parties have rights and obligations that are enforceable due to consequences an entity will face in the event of non-compliance. And with that, I'll now hand over to Liana to take us through the proposals in the Revenue ED.
Thanks, Carly. Firstly, let's consider the current PBE suite of revenue standards, which includes PBE IPSAS 9, 11, and 23. Various issues have been noted historically with the application of these standards in New Zealand as well as internationally. The main concern with the current IPSAS revenue standards was the distinction between exchange and non-exchange, which leads to uncertainty of which standard to apply. This ultimately led to inconsistent revenue recognition for similar transactions. Furthermore, difficulty was also experienced whether the terms in an arrangement is a condition or a restriction, which then impact whether a liability can or can't be recognized. Under PBE IPSAS 23, a liability can only be recognized if it contains a return obligation, which resulted in large amounts of revenue being recognized upfront, whereas the expenses are only incurred in subsequent periods. Furthermore, these standards lacked guidance for specific transactions such as multi-year funding, capital transfers, and so on. Because of these issues, as well as the new revenue standard issued in the for-profit space, NZ IFRS 15 Revenue from Contracts with Customers, the IPSAS-B initiated their revenue project in 2015. In 2020, they released 2 exposure drafts as revenue with and without performance obligations. After considering the feedback received on the EDs, the IPSAS-B went back to the drawing board on some aspects of the revenue standard to come up with a standard that more closely aligns with the for-profit revenue standard. Fast forward to May 2023, the IPSAS-B issued a single revenue standard, IPSAS 47, which supersedes the 3 existing revenue standards. As previously mentioned, we used IPSAS 47 as the starting point for developing this revenue ED and made adjustments to make it fit for purpose for New Zealand's public benefit entities. Before we get into the detail of the revenue ED, I want to focus on the benefits and costs of the proposals. The proposed revenue standard will enhance transparency regarding the substance of an entity's revenue transactions by introducing a more robust and objective approach to recognition and measurement of revenue. Inherently, accounting for revenue may require significant judgment, particularly in assessing the nature and timing of revenue recognition. This revenue ED provides a structured framework to support the application of judgment consistently and transparently, reducing variability in practice. Secondly, the proposed revenue standard will enhance comparability in financial reporting by providing a unified framework for recognizing revenue across various types of arrangements. This ensures that PBEs operating in similar circumstances report revenue in a consistent manner. The proposed revenue standard will also bridge gaps between sectors, enabling more meaningful benchmarking between public sector entities, not-for-profit organizations, and for-profit counterparts. The core principles of the proposed revenue ED are consistent with those of the proposed PBE IPSAS 48 transfer expenses. This coherence is further supported by alignment with the updated PBE conceptual framework and other PBE standards. These revenue proposals are closely aligned with the principles in the for-profit revenue standard, particularly for transactions with binding arrangements. This alignment offers PBEs comprehensive guidance, global harmonization, and enhances consistency in revenue reporting. Additionally, it supports workforce mobility by enabling professionals with for-profit experience to apply their expertise in the PBE space. Lastly, this alignment with the for-profit revenue standard also benefits PBEs with for-profit subsidiaries, sometimes called mixed groups, as it will likely require fewer accounting adjustments when preparing group financial statements. Unfortunately, change comes with a cost. As with any new accounting standard, there will be costs associated with adoption and familiarization. Preparers, auditors, and other stakeholders will need to invest time and resources in understanding and applying the new principles and guidance, which is notably detailed and extensive. The majority of these costs are expected to be once-off expenses during the implementation phase, with minor ongoing costs for periodic training of new staff or for assessing and applying the requirements to new revenue arrangements as they arise. Additionally, as mentioned under the benefits, accounting for revenue inherently may require significant judgment. The Revenue ED introduces new judgments, particularly during transition, as entities reassess existing and new revenue arrangements. Complexity in judgments will vary by entity. These judgments are also anticipated to be concentrated during the initial transition with ongoing expenses where there are new or revised arrangements. Lastly, implementing the proposed revenue standard may involve significant effort. However, for many PBEs, the practical impact on their revenue recognition processes may be minimal, leading to questions about the overall value of adopting such a comprehensive standard. While this represents a one-time implementation challenge, it is not necessarily a direct cost, but rather a consideration of the balance between the effort required and the anticipated benefits. Overall, we expect the benefits of the proposals to outweigh the costs. Now, moving over to the proposals in ED-PBE IPSAS 47, which is a single revenue standard centered around whether a transaction arises with or without a binding arrangement. The recognition and measurement requirements for revenue differ under the two accounting models focused whether a binding arrangement exists or not. There are several new terms in the Revenue ED. Some will be further explained as we go along, but for now, I want to note the resource provider, who is the entity giving the cash or other asset in the revenue transaction, and then the resource recipient who receives those resources and is the reporting entity in the revenue transaction. Finally, we have developed a short webcast that provides a summary of the key proposals in the Revenue ED. You can access this webcast on our website through the link provided on the slide. We'll now focus on the different requirements in the two revenue accounting models. Before I get into the detail of transactions without binding arrangements, I want to highlight one example that may be familiar to you, being local council levies. In these cases, the resource provider, being the ratepayer, doesn't have enforceable rights over how the levy is used. So these levies are typically considered revenue without binding arrangements for the local council as the reporting entity. I'd encourage you to keep this example in mind as we walk through the proposals on how to account for revenue without binding arrangements. For these transactions, revenue without binding arrangements, revenue is recognized as the obligations are satisfied or immediately if there are no enforceable obligations. Assets and liabilities are recognized if the conceptual framework definition of assets or liabilities are met. I'm not going to elaborate on the measurement criteria of revenue, assets, and liabilities, as those mostly align to the criteria for transactions with binding arrangements, which I'll touch on shortly. Instead, I want to focus on some of the examples on transactions without binding arrangements, which includes taxes, compulsory levies, or fines. Specifically, taxes and compulsory levies comes with its own challenges of recognition and measurement. The Revenue ED elaborates on taxes and compulsory levies and includes requirements around when to recognize these transactions, what the triggering events are, and also how to deal with measurement uncertainty, such as collection uncertainty and advance receipts. Now, we'll move to revenue transactions with binding arrangements. But before we get into the detail, I want to highlight a common example again, being capital transfers. These types of transactions typically involve enforceable rights and enforceable obligations on both parties. For instance, the resource provider usually has an obligation to provide the funds and a right that the funds will be used to construct a non-financial asset, while the resource recipient and reporting entity has a corresponding right to the funds and an obligation to use the funds as agreed. I'd suggest keeping capital transfers in mind as a revenue transaction with binding arrangements as we go through the upcoming slides. As previously mentioned, the accounting for revenue transactions with binding arrangements are closely aligned with the requirements in the for-profit revenue standard. The recognition and measurement principles for transactions with binding arrangements centers around the compliance obligation in the arrangement. Each binding arrangement needs to have at least one compliance obligation. This brings us to the compliance obligation definition, which is an entity's promise in a binding arrangement to either use resources internally for distinct goods or services, or transfer distinct goods or services to a purchaser or third-party beneficiary. The delivery of the compliance obligation, in other words, the distinct goods or services, drives when and how revenue will be recognized, as well as whether or not liabilities or assets can be recognized. Therefore, in a binding arrangement transaction, compliance obligations become the unit of account. A 5-step revenue recognition model is followed as follows. Step 1, identify the binding arrangement. Second step is to identify the distinct goods or services. Third step is determine the transaction price. Fourth step is to allocate the transaction price to compliance obligations. And the last step is to recognize revenue as each compliance obligation is satisfied. Now that we've covered the compliance obligation principle, we can move on to the more detailed recognition and measurement principles for transactions with binding arrangements. As noted on the previous slide, binding arrangement revenue is recognized according to a 5-step revenue recognition model. Based on this, compliance obligations can either be recognized at a point in time or over time. Any remaining compliance obligations for which resources have been received but goods or services have not yet been delivered are recognized as a binding arrangement liability. On the contra side, a binding arrangement asset is recognized when goods or services has been delivered, but the entity does not yet have an unconditional right to receive payment. In terms of measurement, revenue is measured at the amount received or receivable. The revenue ED contains various requirements on the measurement principles, focusing on variable considerations such as discounts, significant financing costs, and non-cash components, and so on, which will impact the amount of revenue recognized. On the other side, assets are initially measured at the transaction consideration amount when the criteria for asset recognition is met. Similarly, liabilities are measured at the required amount to settle the compliance obligation, limited to the transaction consideration. It should also be noted that when there is one transaction consideration received, but multiple compliance obligations need to be delivered, the transaction consideration should be proportioned to the different compliance obligations based on a standalone value basis. A standalone value of the compliance obligations can be the price that the good or services trade for in the market, or a cost plus markup assessment, or a combination of these methods. Some examples of revenue transactions with binding arrangements includes capital transfers, as previously mentioned, grant agreements with compliance obligations, and service concession arrangements. One big change to note in this revenue ED is that compliance obligations can arise from promises to use resources internally or transfer to third-party beneficiaries, which also means that deferral of revenue can occur for these types of transactions. Specifically, when resources have been received for internal use under a binding arrangement, and the compliance obligation has not yet been satisfied, revenue can be deferred due to the consequences an entity will face in the event of non-compliance, which has to result in unavoidable transfer of resources to another party. Now, let's move on to presentation and disclosure requirements. This revenue ED requires entities to present binding arrangement assets and liabilities separately, along with receivables where there is an unconditional right to consideration. Revenue must be presented in accordance with PBE IPSAS 1, and major classes of revenue should be shown either on the face of the financial statements or in the notes. For disclosure, the requirements in the revenue ED aim to help users understand the nature, amount, timing, and uncertainty of revenue and related cash flows. The proposed disclosure requirements align with the requirements in PBE IPSAS 23 and the for-profit revenue standard. And similarly, the disclosure concessions for Tier 2 PBEs also align with RDR concessions currently available in PBE IPSAS 23 and the for-profit revenue standard. Lastly, the proposed revenue standard addresses common challenges with previous guidance by offering additional support for transactions like capital transfers, multi-year funding, appropriations, and services in kind. It also includes extensive application and implementation guidance, plus 56 illustrative examples to assist with practical application. This brings us to the end of the revenue ED. I'll now hand over to Carly to cover the transfer expense ED.
Thank you, Liana. And I'm sorry, everyone, but I'm not going to give you a lot of time to absorb the revenue proposals before I have to ask you to now switch perspectives and consider the accounting from the point of view of a reporting entity that incurs transfer expenses. So first of all, what is a transfer expense? It is an expense arising from a transaction other than taxes in which an entity provides a good, service, or other asset to another entity or individual without directly receiving any good, service, or other asset in return. The entity providing the resources is referred to as a transfer provider in the transfer expenses ED, and the entity receiving the resources is the transfer recipient. Examples of transfer expenses may include grants and donations given in cash or other assets, and social welfare payments. Now, before we go any further, let's first take a look at the expected benefits of these proposals. A key benefit is that PBE IPSAS 48 transfer expenses would fill the gap in PBE standards, as there are currently no specific requirements addressing the accounting for transfer expenses. So by filling this gap, PBE IPSAS 48 would allow for increased consistency in the reporting of transfer expenses across the PBE sectors using the latest international thinking. Other benefits include guidance on challenging accounting issues and the alignment of key principles for transfer expense accounting with those in the revenue ED. The change does come at a cost, so we expect that, similar to the revenue ED, implementing the proposals would require time and resources and would potentially create challenges with the introduction of new areas of judgment. But overall, we expect the benefits of the proposals to outweigh the costs. Now, this slide sets out some of the key features of the transfer expenses ED. The accounting for transfer expenses is driven by whether the transfer provider has an enforceable right to have the transfer recipient satisfy its agreed upon obligations in return for receiving resources. Such a right is referred to as a transfer right in the transfer expenses ED. For a transfer provider to have a transfer right, there must be a binding arrangement. So ultimately, transfer expense transactions require different accounting treatment, depending on whether they involve a binding arrangement or not. Therefore, similar to the revenue ED, there are two models of accounting for transfer expenses, as shown in the diagram here. And again, similar to the revenue ED, there are several new terms to become familiar with, some of which are listed here and that I've already mentioned. I'll introduce you to some of these as we go through the presentation. And finally, we have developed a short webcast that provides a summary of the key proposals in the transfer expenses ED. You can access this webcast on our website through the link on this slide. So let's now take a look at the first of the two accounting models in the transfer expenses ED, transfer expenses from transactions with binding arrangements. As we go through the next few slides, we'll use an example whereby the transfer provider is a local government entity that enters into a binding arrangement with a transfer recipient to build a new community centre. We'll refer to the transfer provider as local government A and the transfer recipient as entity A. So firstly, under transfer expense transaction with the binding arrangement, the transfer provider must identify the number of distinct and separately enforceable rights it has under the arrangement. So these are rights to have the transfer recipient satisfy its obligations under the arrangement. The enforceability of the binding arrangement is what makes the transfer provider's rights enforceable. Some examples of a transfer provider's rights are shown in the box to the right on the slide here. There will always be one such right in a binding arrangement, and this is the transfer right that I mentioned previously. Typically, the number of distinct enforceable rights will be evident from the negotiations between the parties, and in some cases, multiple rights would have to be aggregated in order to produce a distinct right that can be enforced separately. So in our example, Entity A has agreed to perform the overall management of the project to build the community centre, as well as other tasks necessary for the build, including design and engineering and site clearance. Within the context of the binding arrangement, these rights are all highly interdependent and interrelated, as the individual services together result in the building of the new community centre. Therefore, local government A, as the transfer provider, would aggregate these related rights into a single transfer right, which is to have Entity A build the community centre. It is important to determine the number of transfer rights within the binding arrangement because transfer rights provide the basis for the timing of recognition for transfer expenses, where they are recognized as assets. So now that I've spoken about transfer rights, we need to establish when such rights are recognized as assets. But before I get to this, what are transfer obligations? What about these? So remember, for an arrangement to be binding, both parties will need to have enforceable rights and enforceable obligations. For transfer providers such as local government A, its obligation would be to transfer resources, such as, for example, cash, to Entity A in return for building the community centre. These resources, referred to as transfer consideration, are allocated to the transfer rights, or in this example, to a single transfer right. I'll give you more detail on how this is done later on. So before either party has begun to perform under the arrangement, it's important to note that each party has interdependent and inseparable rights and obligations, and therefore, technically speaking, a combined asset and liability, which is measured at zero. So recognition of an asset or liability in the financial statements relating to the rights and obligations under the arrangement will therefore depend on which party starts to perform first under the arrangement. Now, for example, if local government A transfers some or all of the funds to Entity A before Entity A has engaged in the agreed upon activities, local government A, as a transfer provider, will recognize a transfer right asset, representing its right to Entity A's performance under the arrangement, similar in some ways to a prepayment. In cases where Entity A performs or starts to perform under the arrangement before receiving the funds, local government A recognizes a transfer obligation liability for the transfer of resources, which is similar in many ways to an accrued expense or transfers payable. Now let's take a look at the recognition of the transfer expense As noted here on the slide, there are two ways that a transfer expense is recognized. Firstly, where there is a transfer right asset, the expense is recognized as or when the asset is derecognized, which occurs when the transfer provider no longer has enforceable rights in accordance with the binding arrangement. And typically this occurs when or as the transfer recipient satisfies its obligations under the binding arrangement. Where the transfer provider's transfer rights are reduced as the transfer recipient satisfies its obligations, this will result in a gradual derecognition of the transfer right asset and the recognition of the transfer expense. In our example, this would occur as Entity A constructs the community center. In this situation, local government A must be able to reliably estimate Entity A's progress towards complete satisfaction of its obligations. So let's assume that local government A can do so using a measure of costs spent on the construction activities to date. In cases where local government A could not reliably estimate Entity A's progress, derecognition of the transfer right asset would have to occur immediately, as it then cannot be reliably measured. Where the transfer recipient is unable or unwilling to perform in accordance with the binding arrangement, the transfer right asset may either be impaired or derecognized, with a financial asset recognized in its place. This would happen where, under the terms of the binding arrangement, the transfer provider is entitled to receive cash as a result of the non-performance. Now, when there is a transfer obligation liability, the corresponding expense will be recognized at the same time. As noted on the previous slide, a transfer obligation liability is recognized when the transfer recipient performs first under the arrangement. A transfer obligation liability could also be recognized when there is variable consideration in the binding arrangement. So this could happen, for example, when the transfer provider's obligation to transfer resources is contingent on the occurrence or non-occurrence of a future event. Variable consideration may also result from items such as discounts, rebates, or penalties, for example. Consideration which is variable may meet the definition of a provision in PBE IPSAS 19, where it is more likely than not that a present obligation exists for the transfer of variable consideration, then it is initially and subsequently measured under PBE IPSAS 19, which is the provision standard. When measuring the transfer expense, the transfer provider must consider the terms of the binding arrangement to determine the transfer consideration, which, as mentioned previously, are the resources that the transfer provider is required to transfer to the recipient. Specifically, the transfer consideration is the total carrying amount of these resources and includes the effect of variable consideration. When determining the transfer consideration, the transfer provider must assume that the recipient will perform and that the binding arrangement will not be cancelled, modified, or renewed. I mentioned previously that transfer consideration is allocated to the transfer rights in a binding arrangement. This is either done in accordance with the binding arrangement, when the allocation is specified there, or by determining the best estimate of amounts intended to compensate the recipient for its performance. Therefore, as the relevant transfer right is extinguished, the transfer expense is measured at the amount of the transfer consideration allocated to that right. In our example, though, local government A only has the one transfer right under the binding arrangement, and therefore the transfer consideration is allocated in its entirety to this transfer right. Now let's move on to the second accounting model, which is transfer expenses from transactions without binding arrangements. Now, when there is no binding arrangement, there can be no transfer right asset, but the transfer provider may still have a legal or constructive obligation to transfer resources to the recipient. And therefore, the first step would be to determine whether the transfer provider has a provision recognized in accordance with PBE IPSAS 19. If no provision is recognized, the transfer provider will recognize the transfer expense when it no longer controls the resources and will measure the expense at the amount of the transferred resources. Where a provision is recognized, the expense will be recognized at the same time as the provision and measured in accordance with PBE IPSAS 19. Now, this accounting model is applicable when local and central governments provide social welfare payments to beneficiaries, as well as services such as education and health, where the definition of a transfer expense is met. Social benefit transactions such as these do not have binding arrangements because at least two parties to the arrangement must have enforceable rights and obligations. Individuals and communities would not have an enforceable obligation to central or local governments in return for the transfer of goods, services, or cash, hence why there is no binding arrangement. Under this accounting model, the transfer provider will need to consider whether it has a legal or constructive obligation to provide the resources to the transfer recipient. We've proposed to add guidance to PB IPSAS 19 to help central and local governments determine whether they have such an obligation arising from existing public policies, budget policies, election promises, or statements of intent. This new guidance replaces the scope exclusion in PB IPSAS 19 relating to obligations of the Crown expressed in legislation that have characteristics similar to an executory contract. We are aware that central and local government entities have developed their own accounting policies when accounting for social benefit transactions based on the requirements of PB IPSAS 19. Therefore, we do not expect that including these transactions within the scope of the ED will result in a significant change in the accounting. Now, to finish up this section on transfer expenses, I'll briefly touch on the presentation and disclosure requirements in the transfer expenses ED. The transfer right assets and transfer obligation liabilities, as I noted earlier, are similar in nature to prepayment assets and transfers payable, respectively. There is guidance in PB IPSAS 1 relating to the presentation of these. In the Statement of Comprehensive Revenue and Expense, the transfer expense is recognized as a single line item or by program or purpose, depending on whether the nature or function method is used to present expenses. Transfer providers are required to disclose qualitative and quantitative information about their material transfers to enable users to understand how the entity's resources are spent on its programs and activities, as well as qualitative and quantitative information about their material transfer arrangements. For those transactions with binding arrangements, additional disclosure would be required relating to the realization of transfer right assets and significant judgments around their recognition. We have also proposed to provide disclosure concessions for Tier 2 entities relating to some of these requirements. Presentation and disclosure required by other PBE standards are also relevant, depending on the types of assets and liabilities arising from the transaction. And then finally, similar to the revenue ED, the transfer expenses ED addresses common challenges, as shown here, and includes application and implementation guidance. There are also 11 illustrative examples in the transfer expenses ED to assist with practical implementation. I'll now hand back to Michelle. Thank you very much.
Thanks, Carly. And Liana, both for your insights and just taking us through these exposure drafts. As Liana mentioned at the start of this webcast, it's really important to understand, we understand that there is some complexities or a lot of complexities in these exposure drafts. That's why we have also issued alongside these exposure drafts some educational guidance and just breaking down these concepts. So as you are working through these exposure drafts and figuring out what that might mean for your entity, I think that's a useful tool to start off with, and then don't use that as a replacement of the standard, because the standard does have quite a lot of detail in there, but it is a useful tool just to see a fact sheet on a page, what is it principally trying to do, and then also just the breakdown of the concepts, etc. Yes, so we are looking forward to hearing some feedback on these exposure drafts. Our consultation closes on the 1st of December 2025. So as you know, a normal consultation period for us is generally 3 months, plus or minus, depending on the nature or the extent of the exposure draft being exposed. We've decided to keep this open for a longer period, just because of the nature of these proposed amendments. It's useful for people to have more time to work through these proposals, and also to allow you time to give us good feedback as to if we got it right, or if there's stuff that we need to amend to make sure that there's no unintended consequences by bringing in or introducing these standards. I'm going to highlight again, these standards are not yet proclamated, so it's not been gazetted yet. It's just exposed for consultation. So we really just want to hear your feedback on these exposure drafts. And in these exposure drafts, we also have a proposed effective date on the 1st of January 2029. So I might kick off some questions, and then I'll deep dive some of the questions that has come through during the course of this webcast. So, Carly, I might ask you first and foremost, do you think the 1st of January 2029 allows enough time for entities to prepare for this these exposure drafts or for these proposals?
Yes, so that 2029. So what we are planning to do is look to issue final standards in around Q3 2026, which then would still give over 2 years for implementation. Specifically for transfer expenses, the ED proposes to allow entities to apply the standard prospectively to all transfers occurring on or after the date of initial application. So that also reduces the time and cost to implement the standard by not having to do any retrospective application. With respect to, I can't quite recall the proposals relating to revenue in that regard, but in any case,
So,
yeah.
Leona, wondered if you wanted to just expose or elaborate a little bit on why we are proposing or consulting on both as revenue and the transfer expenses ED simultaneously. So both of them are quite big standards. It's useful to understand why we have decided to consult concurrently.
Thanks, Michelle. Thanks for that question. So as you would have seen as we went through these proposals, there are quite similar principles, or there are some shared key principles within both of these EDs, which will help ensure consistency when your revenue and transfer expense transactions, and as they cascade down through different entities in the public and the not-for-profit sectors. Additionally, these consultations are also run at the same time to allow entities involved in both types of transactions to assess the proposals at the same time. So therefore, identify any overlaps or gaps and provide more useful, and that allows you to provide more useful feedback to us without having to go through 2 separate consultation periods. So overall, I think there are benefits in running them together.
Perfect. Carly, I'm going to just direct this question to you that's come through the Q&A box. These standards, are they applicable to Tier 3 and Tier 4 PBEs as well? Or do we envision that it might come through later on? I'll pause there.
Thanks for that. No, these standards are only applicable to Tier 1 and Tier 2 not-for-profit and public sector entities, and there is no plan at all to introduce these in Tier 3 or Tier 4, as those tiers have separate standards which have requirements relating to revenue and expenses. So it's just Tier 1 and Tier 2.
Perfect. Leona, a question that's come through is, what do we do when it's difficult to identify the compliance obligations? For example, we've got a number of, the example in here was pet registration revenue will be used for a variety of obligations for councils.
So within the revenue ED, there is quite extensive guidance of how to identify your distinct goods or services. So it is important that you think of, they need to be distinct and stand alone. So I think if you are struggling to identify or to know where your compliance obligations lie, I think look at the guidance within the revenue ED or within the proposals, and that should guide you in the right direction of identifying your compliance obligations.
Yep. I think this is a comment, but I think, Leona, this is also for revenue. On page 86 of the revenue standard, the donations and grants were recognized as without a binding arrangement, but sometimes they will, for the donations and agreements for the grants. I presume it meant to say there will be a binding arrangement for donations and agreements for grants. And
sure,
I'll let you answer.
Sure. So in the implementation guidance, I think it's section G within the revenue standard, there is additional guidance more focused on not-for-profits, but I think it can be applied by both public sector and not-for-profit entities, basically on on various types of bequests, donations, and those type of transactions. In terms of saying that it is definitely a binding arrangement, that won't necessarily be the case. I think each arrangement needs to be assessed based on its own merits and consider whether both parties in the arrangement have enforceable rights and enforceable obligations. So if you do have donations or grants that both parties do have those enforceable rights as well as enforceable obligations, then you may as well have a binding arrangement. So it is very specific to go through your individual arrangements and assess the terms and conditions to those arrangements to identify whether you have a binding arrangement or not.
Great. Sorry, Leona, there's a lot of questions on revenue, so I'm going to throw another one to you. Do these proposed standards impact the revenue and expenses recognized in other comprehensive revenue and expenses, or only the statement of revenue and expenses?
So it impacts your revenue. So more your revenue in your normal income statement. So your
Yes.
revenue that gets accounted for in your normal trading operations.
Yep.
So yes,
I might add.
Yes.
No, that's right. I think in the ED, it specifically excludes from the scope changes in valuations, etc. So that will mean it excludes your OCI, which is your other comprehensive revenue and expenses movements generally. So, all right. Sorry, I'm just quickly going through. There's quite a few questions coming through, so I'm just going through what I can answer. Can a vested asset, so this is for you, Carly. Are you ready?
Mhm.
Can a vested asset expense, i.e. an expense incurred to build an asset to vested to other entities, be classified as a transfer expense?
Okay. I haven't actually heard the term vested asset expense before,
Yes.
but
Same.
so I see expenses incurred to build an asset to be vested to another entity. So I suppose you'd have to look at the transactions. So if it's you'd have to determine whether you have a binding arrangement between two parties for maybe one party to build the asset, who may then or maybe building it on behalf of a third-party beneficiary, for example. So you just have to apply the principles in the standard. First of all, is there a transfer expense? Is the definition met? Then do you have a binding arrangement? And if so, then you would account for it under one of the two models, well, depending on if you have a binding arrangement or not. But yeah, the standard does contemplate that you would have third-party beneficiaries that wouldn't necessarily have rights and obligations themselves, but it may be that one of the obligations of a transfer recipient would be to perform, or to build an asset, and then to ultimately on behalf of to then transfer it to a third-party beneficiary.
Great. I think we've answered quite a few questions. I guess a lot of the questions in here is very specific to your entity specific. Obviously, there's a lot of judgment involved in both expenses or both revenue and transfer expenses to determine whether or not there's a binding arrangement. How do you go about the compliance obligations? How do you go about identifying if it's a transfer expense or not, etc. And I guess while you are working through that for your entity, it's useful to make notes if there's stuff that's in there as you're going through the exposure drafts. If there are stuff in there that you come across that you think actually that doesn't make sense, please reach out to us and then we can figure out whether or not that is correctly whether or not that is right in the standard, or if there's an amendment needed from the standard perspective. All right, that is about it. I'm going to end this session, and I'm going to just say thank you very much to both Carly and Leona for sharing their insights about these exposure drafts. We will have more webinars and more materials coming out on our website. I do encourage you, read the standard, do liaise with us and reach out to us if there are any unintended consequences that you foresee. And also if there's benefits in us, if there's collective type of revenue transactions or transfer expenses transactions that in a whole subgroup might affect more than one entity that might not be captured correctly in that regard. All right, with that, I'm going to close off and have a lovely afternoon, everybody. Goodbye.
Bye.